Hi everyone, I wanted to do this quick take on what has become a very relevant and extremely excessively talked about topic. Also, it's a repeat on what I did. In fact, 8 to 9 months ago, I did a video showing exactly this, the dollar and bond market relationship. But I think public memory is short. And also, right now, this is the event that is going on post the Fed rate related announcements. You've been seeing bond yields continuously fall, and more recently the dollar sold off. So it comes back again that everybody in the media keeps saying, oh well, when yields go down the dollar goes down, when yields go up and the dollar goes up. And I in fact showed this relationship in my last update. Like I said, 8 to 9 months ago I did a video on the bond and dollar market, because that time interest rates were going up and people are saying the same thing, that the dollar is rising because of rates. So I'm going to actually prove that wrong. While it is true in the short term, so you might have relationships which are 1 month long, but when you might look at a 30-40 year chart and say, oh well, it looks like they're going in the same direction, which is not really relevant, because what you're looking at when you look at a 40-year DXY is you're looking at a relative rate, because it's not the dollar but the dollar relative to a basket of currencies. So the point is the DXY versus the 10-year US rate in the medium term, which I mean lasting for a couple of quarters to a couple of years. What does the trend really look like? And so this chart shows several cycles from the 1970s. Okay, and I'll go to an actual investing chart which is updated to date, but this one is just to show you a historical perspective, so that what I'm saying is not only true just now, but it's true on a historical basis. So what's happening here is you can see 1975 to 1981. You would have read many times over, this was an inflationary period in the US as prices of commodities were shooting up, including everything from copper to gold. And as they did shoot up, interest rates were raised, time and again to slow down the rate of inflation. So what happened when you raised interest rates? Theoretically, you would say the dollar should have gone up. This is what the media says. This is what a lot of analysts come and say and theorize on television as if it's economic theory. But most of this economic theory is already been dusted. It is only taught in the old textbooks. It's no more relevant in a floating rate currency environment. It is only true when you study on a fixed rate environment as to, what are the potential movers for a currency or forex market. So you look at things like interest rate, parity, blah, blah, blah. But those are not relevant as you see on these charts. This is a period interest rates are going up. That's the orange line. What was the dollar doing? It was actually falling all the way till this point. So I've shown from this bar to this bar, you had rates going up, dollar falling. Eventually, yes, the dollar did turn around here and rates were rising for a short period of time, which is why it looks like there's a correlation. But most of the rest of this dollar run was occurring when rates were actually coming down, because once you had inflation under control and interest rates started to come down, you have a dollar actually continuing to rise. So how come rates are going down and dollar is going up? This is exactly the opposite of what you're being told. Repeat, 1993 to 1998, you had rates going down, dollar going up, and then again you had rates falling all throughout this while when you had this dollar rally. So you would have, again, anybody who's been studying the dollar market, 1994, 95 all the way till 2002 was a dollar bull market. The second half of the dollar bull market is the second dollar crisis, is when the tech bubble peaked, and you had a lot of other crises prior to that, from the Russian market, and the LCTM crisis, many others which happen typically when you have a dollar rally. Pressures on, some markets always show up, and that's what happened during this phase. What were US bond yields doing? The 10-year bond yield was falling throughout this period. As you can see over here, the orange line has been dipping while the DXY was going up. So where's the relationship? You'll see these short periods here where it looks like, yes, rates are rising and the dollar is rising. And during those periods, you'll find everybody theorizing on that classical theory that, oh yeah, this interest rate parity, you're getting, rising dollar along with rising rates. But this doesn't exactly work. So I'll come to why. I'll repeat why. But just again, now let's come to the current period. 2008 onwards, what happened? You had the great financial crisis, and then they started to cut rates and do QE. So interest rates started to fall from 2008 all the way to 2016. Everybody should remember 2016 is when the the international bond market, or the US bond market in particular, peaked. The 30-year bond yield made its lowest level, or the bond prices made its highest level in the year 2016 on excessive long positions and sentiment. So that's already published opinion. So this is that point here where interest rates were at their lowest, from where bond yields started to rise. What is the dollar doing throughout this period? It was going up. In fact, it peaked in 2016 at 104, just a little after this interest rate bottom. So once rates started to turn, eventually the dollar turned down and it was going the other way. So that's what this shows. And the reason this happens is it's very simple. And I say it that, well, if flows are what you're reading into the dollar market, which means is money flowing into the US or is it flowing out of the US? So if money is flowing into the US, which means, say, if China, India and various other emerging markets are accumulating reserves and they're using those reserves to buy US bonds, what would happen? You would move those dollars into US dollars, which means there would be a dollar demand to buy the bonds. So money would first flow into the US market and then buy the bonds, which is why the bond market should go up when the dollar goes up and the bond market should go down when the dollar goes down. That's the logical relationship versus an interest rate parity thing saying that, oh, well, the currency should weaken when you bring down interest rates. That's usually a lagged effect. So like you see here, interest rates, did the dollar fall? It fell over here from 1970s, mid 70s all the way into 1982, a time when interest rates were going up to fight inflation. Not when interest rates were actually going down. So, what would have been happening when interest rates were going down? Money would have been flowing out of US bonds and that was driving the dollar down. So that's the real relationship rather than the value relationship. When you consider a period of time, of course, there are short periods where it appears different and it sounds very nice to theorize and say that's what is happening. So flows are what drive the move. That's the key point and takeaway. Also, when you have key turning points, now let's just go back to 2008. What do central banks typically do? When your economy starts to weaken, they start to try and stimulate. So essentially what was happening before that period was money was moving into equities and out of bonds. So bond yields actually rising when equity prices are going up. Now this is more because of the risk parity trade, which means that money moves from equities to bonds or bonds to equities. So when money moves into equities, bond prices tend to go down and rates tend to rise. And while that is happening, money is moving out of bonds and rates are rising. Money is flowing into equities. You have the dollar essentially weakening because of that trend strong equity trend that is going on. Now, at the same time, the reverse also tends to happen is when at the fag end, as rates continue to rise. So it's not the turning point. So what most people think is that moment you start raising rates, the dollar should go up. It's not that point where the dollar turns and starts getting stronger. It's at the end of the rate cycle when rates have gone far enough. So the intention actually of raising or lowering rates is to, of course, weaken or strengthen the dollar, but it doesn't happen on the first cut or first hike. And that's the key takeaway. So just because, I mean, you haven't even had the first cut here. So when did you get the first cut the last time? It's after 2008. And when that happened, when you did the first cut, did the dollar start falling right away? No, it took its own time. So you keep cutting yields, keep bringing down interest rates till the point where you actually get the weakening effect, So it happens with a lag, but not immediately. Similarly, in 1981, after rates were raised significantly, did you get the dollar to turn around, and that stabilized inflation and then eventually interest rates came down. And so similarly, when you're stimulating, when you keep trying to bring interest rates down, eventually you cause the dollar to weaken, which is what happened between 96 and 2003. Rates were down, stock markets were doing really well. But it took a point for the dollar to actually start rising and, start falling rather. So it took all the way till 2001 for the dollar to start falling. Till that point of time, the lowering of rates was not really having an impact. So now we come into so let me just take the current scenario. And so the current scenario we are looking at now, this is the same chart. I've plotted it on Investing the Two. But it's more updated. That one was till 2017. Now you're looking at the recent period. So when you look at this period, you can see the inversion. The dollar is going up, interest rates are going down. You can see it even in the most recent period. So we had the bottom in interest rates and bond yields here, exactly when you had the dollar at the peak, right? And so you had this peaking point when these yields went up here, dollar was flat. When the yields were going down, the dollar actually went up as money was moving into the bond market when yields are going down. Similarly, you had the same relationship here. The dollar is falling, yields are actually going up. Now we know yields moved up here from around the sorry, 1.6 or 1.3% all the way to, almost 3% on the 10-year. And while that happened, when we hit that point at 3.07%, we actually, so this was around not 1.3, 1.45 is the low that this is showing on a closing basis. And then this closes at around 3.15%. At that point of time, the dollar bottomed and starts to rise. Now what has happened here is you are seeing this inversion. So note, even while yields have been falling, and this has been happening since the start of this year, since October of 2018, you've seen yields reverse and start to fall, especially after the US stock market started to crash. So money moved out of equities into bonds, and the bond market started to go up, and so yields started to come down. Very simple equation. And what would happen when money is moving into bonds? The dollar should go up. This is what you're seeing. What you see is a lead lag between these two happening, and that's where all the talk occurs, which means here, when you actually had the dollar falling and yields were going up, nobody would have talked of this relationship because it would have made no sense. But for this short period of time, it made sense of talking of, well, the dollar is going up and yields are going up, and most of the yield move has already occurred. So it's historical. And when you're actually at a turning point where this trend was probably leading in indicating that this trend is going to turn, and eventually it did. So this rising dollar eventually led to enough money flowing into the bond market to drive it down. Now, here suddenly after the Fed's announcement that they're going to cut rates, you have 1 month, just 1 month where the dollar is down and bond yields are down. And so suddenly everybody is talking about how lower rates are bearish for the dollar, when there's actually no significance of that statement on a historical basis. In fact, if the bond market continues to show strength, in other words, if you continue to see lower yields as you're even seeing today, eventually it should mean a stronger dollar. If money is going to flow into US bonds and out of US equities, it should mean a stronger dollar. So that's the simple theorem that I would put from a medium-term multi-month perspective. 1 month here and there, you can always get a breakaway of this relationship. But if it's a strong multi-month trend, then it's unlikely to be the case. So I hope that throws light. I think a second time I've done this topic simply because when I hear people making these correlations, it doesn't make sense to me. That's all in this update. I hope you are able to take away an important data point.